So we've got a few questions to ask. What is President Buhari's debt managers' strategies? What are they achieving? And how can you trade and invest in the new domestic debt market direction? And how much is left to be done? And that's the conversation we're having now with Robert Omotunde, who is the head of research at Afrinvest. And just a little bit, a PR there for Afrinvest. That's the first investment firm in Nigeria to roll out a debt portfolio or mutual funds 21 years ago, 1997. That's about, 96, 97. That's when you had the NIDF, Nigeria Investment Debt Fund. That was the first dollar-denominated debt fund in the Nigerian market, priced in dollars, listed on the Nigerian Stock Exchange, tied to the 30-year U.S. Brady bonds. And I remembered all that just like yesterday. So let's talk to Robert here, this man who knows about the debt market in-house. Good morning.
Thank you, Boason.
You're going to pay for that PR.
Yeah.
Just in case I get a debit note, I'm going to push that to you. So just add that to your end of year, your giveaway.
I'll buy Pluto's fund for you. Yes. To pay you for that PR.
With the yields going down, I'm not too sure I want that. I would have taking that from you when rates were 20%. Now you're offering me when rates are going down to 8%. But it's still a good one to have you here. Yeah. Welcome back from This is a report. Look at this Bloomberg report, and that's what this morning, when Nigeria was ranked among the best performing global emerging markets in 2017, taking our slot alongside South Africa. It's been a very nice year overall.
True.
On both sides of the strait.
True. Of course, this is not surprising. You know, in the financial markets, policy is everything. You know, when you have the right policies, you know, investors always want to invest. You know, and what we've seen in 2017 was Nigeria moving in the direction of the right policy that we ought to have. And this turnaround came when we launched the investors and exporters window. You know, it has been phenomenal for the financial market, especially the launch of that window. You know, you would notice that was when we saw the liberalization of the foreign exchange market. You know, even though you still have multiple rates in the system, you know, that will change over time. But I mean, the launch of that window single-handedly has led to the 46% that we've seen in equities market year to date. You know, it has also accounted for the much of activity we are seeing even in the fixed income space.
Okay.
Yep.
Just about 3 months ago, let's get to business. President Buhari's debt managers are led by the Ministry of Finance and, of course, in bed with the DMO and the central bank unveiled a new debt strategy. Of course, this was expected because it looks like they're getting hanged by the day looking at the size of the local debt and the plans they have to borrow globally. So they had to rebalance the portfolio. So there's a strategy that they've come up with. Do you think we are seeing implementation of that strategy that was announced by Kemi Adeosun?
Yes, indeed. Remember that they came out to tell us that they want to structure the debt portfolio of government such that they have 40% of foreign denominated debt and, of course, 60% of local. There's a skew currently because the local debt, you know, has always been like 70% of the portfolio, you know, and what their own clear strategy for doing that was to say they were going to approach the international debt market. Remember, when we went to the international debt market, the Eurobond market to be specific, in February, you know, we saw how a lot of fund managers were hungry for Nigerian instrument, not just Nigerian instrument, emerging market instrument because of the high yield, you know. And the rate of success that recorded also informed the new issue, which we saw in November, where the federal government issued a 30-year instrument, you know, at 17.6%, and another 10-year instrument, I think about 16.5% coupon. I mean, 6.5% coupon, you know. And what they are targeting at doing, even though they raised about $3 billion, you know, as at the last time they went to market in two tranches, they are looking at refinancing the short-term debt, domestic debt, to the tune of about $500 million, you know, and that technically should account for what you're seeing right now, the news flow that the Debt Management Office is not willing to do a rollover of what we would normally see. Typically, what you will see is they come to the market on a maturing treasury bills date, and they roll over the same amount. So it's been a way of refinancing, those debts. As far as I know, this has been on for more than 3 years, and this is a change in strategy.
So they want to close down on this?
Well,
write it off, pay it off.
Exactly. So in this particular time in December, they are not rolling over the maturing bills, which has been summed up to, for this week, we have about 146 billion maturing in treasury bills. Next week, we're going to have another 50 billion worth of treasury bills maturing. And these are instruments that the DMO wants to pay down without rolling over. Whether this is optimal, in terms of the cost of financing, will be a different conversation in itself, because when you match a long-term refinancing option for a short-term debt, then you now begin to see, you may not be able to analyze how impactful that will be, until you see what the interest rate, future interest rate will look like.
For that, the long-dated window, which you're taking up in dollars moving forward.
Correct.
So you have a number of external issues to deal with tomorrow and the day after.
Exactly.
Very interesting today.
Some exchange rate issues to worry about.
Because
these are foreign.
The currency risk to that as well. And interest rate risk as well. As we look at the U.S. Fed, most likely today, some folks says Janet Yellen may just raise interest rate.
The rate is going up
even if that's going to be a goodbye move from her before the new Fed chief comes in office sometime next year. But again, locally, it's always been a matter of rebalancing, and folks have always knocked the central bank, knocked the government, knocked the banks from profiting from using government money to buy government papers and cream off a decent return on it. Those days are getting over, yes or no?
Well, it's a point of looking at what the government is trying to do at this time. Remember that in the fixed income market or any other market whatsoever, fundamentals always drive the market. And in a typical market, you will have the buyers and the sellers. Historically, the federal government and the central bank have been the largest supplier in the fixed income market. At the treasury bill hands, the short-term hand, the central bank, supplies the treasury bill. They also supplied OMO for their monetary policy management. At the long-term end, the DMO, we always issue, short-term and medium-term bonds, for the financing of government budget. Now, you're seeing a situation where the government is now thinking about its own cost of borrowing, which is why they are saying they want to do some refinancing with some foreign denominated loans, in order for them to be able to pay back, their short-term debt. But the point here is that, yes, the banks have always taken advantage of the interest rate environment. You can't blame the banks for that, because all the banks are there to do business. And for as much as the opportunities are available for them to plug in, at the end of the day, it's the shareholders fund, that benefit, from whatever return they make. So they are actually working for their shareholders, right? So, but the point here is that the moment when you start seeing a sort of moderation, like we are currently witnessing, which is also guided by what I call the largest suppliers in the market. Already the central bank, apart from the last MPC meeting when the central bank governor hinted of a possible gradual easing of rates, we've seen actions following, because the federal government is not, central bank is not issuing the long-dated OMO bills anymore. They've got to cap it at the 6 months tenor of the OMO bills. And that coupled with what you've seen in recent auction conducted, the last treasury bills auction we had in November, you saw that even investors are not willing to play within the 91-day or the 182-day. Most of the investors are going for the 364-day instrument because of the attractive yields, of course. So now the question now is that as much as the reality is coming in that the yield environment is beginning to moderate, investors are still trying to see how much of position they can take to lock in the rate, at least for the next 365. So if you're buying a 364-day instrument currently, you're able to get at a rate of 14 to 15%. You know, you're still able to lock in that rate at least for the next 1 year, even though you know that the interest rate environment, you know, it's improving.
Before the central bank, before the central bank start to open the tap.
Exactly. Now, already liquidity in the system is, I mean, unlike what we've always had, even this time last week, we had negative liquidity position for more than 3 days.
It looks like
so
much money now.
As we speak, there's so much liquidity now, relatively, because now we have about, as of yesterday, about 450 billion, you know, in terms of liquidity. There's it's an OMO that is maturing tomorrow, about 70.1 billion. If you add that to the Treasury bills maturity of tomorrow also, which is approximately 150 billion, you know, you're talking about, you know, so much of liquidity in the system. Of course, 800. Yes, you can see the OBB rate, you know, crashing to as low as 2%. I mean, 2.3% as at the close of market.
I need that money. I need that money. If I didn't open buyback, but we can about 2%.
Yes, we can't also be sure that the central bank will not at this time, even though we know that the body language is suggesting that they want to ease. But the development within the global space is something to watch. You know, ECB, you know, raised interest rates at the last time, you know, the committee met. The Fed is meeting today, and it's almost certain that the rate is going up again because of the tax cut policy, which is already being discussed at the Congress now.
Trump's tax.
Yeah. So that is going to be expansionary. So in response, the monetary authority, which is the U.S. Fed in this case, is going to most likely take that rate up. You know, and then you see Bank of England too, you know, raising rates. So at the domestic front, you know, even though the body language is suggesting that easing may be the new norm, the central bank, we believe, will also be trying to be watchful of the development within the global space, because as interest rates are going up, you know, it makes those regions also very attractive.
Very attractive for investors who may take some exit,
Correct.
who may just open some windows in Nigeria and do some exit because, but again, if you throw the 750 billion Kemi Adeosun's budget 2017 capital projects money into the market right now and put that as part of the liquidity, if that money comes in this week, we're looking at well over $1 trillion.
Correct. Yes, but you know the perspective, you know, which has always been.
So would the central bank be forced to throw some OMO into the market?
Remember, if money has been signed for capital projects and the liquidity hits the system, of course, because if you have a contractor who owns a bank account, you know, the money probably hits his bank account, then you see, you know, the system liquidity, you know, showing. But the point is that even when the central bank issues an OMO security, you know, because some of this liquidity are tied to projects, you know, the impact on liquidity that causes, you know, expansion in money supply is not as grievous when the spending is on capital project as to when it's on recurrent expenditure. You know, so clearly put, there is going to be so much of the system will be so much awash with a lot of liquidity. You know,
so whether the central bank, few weeks of December,
whether the central bank is now willing to conduct mop-ups, you know, will now be a different conversation. You know, but what we know is that they're already signaling that they are less aggressive in terms of liquidity mop-up. Otherwise, we should have seen some OMO issuance on Friday or probably yesterday. You know, when we saw that 450 billion, but we never.
But most likely, the central bank, we're watching the debt, the DMO.
Correct.
Once the DMO is going to redeem 198 billion, almost 200 billion, and do another auction today of 100 billion, 2-5-year reopening. Some folks are saying that auction today will be oversubscribed. What's your take? Do you think?
Well, that has always been the trend. You know, you see a situation where because of interest rate environment is moderating, like I mentioned, you know, most investors are trying to take the best opportunity they can take, especially within the short-term space. So the likelihood is that the auction is going to be oversubscribed, you know, because there's now the system is now becoming short of supply, whereas there's this huge demand, you know, and that in itself is helping to drive down the rate. Because remember, it's not the central bank or the DMO when they conduct the auction that will fix the rate. It's the market that still guides. That's why you always have the range of bids, you know. So, but market watchers will look at the liquidity dynamics in the system, they will look at the amount of supply available before they start taking position.
They have money to buy DMO from the repayment that is coming.
Exactly. So the much of liquidity,
yes,
you know, available for the not so much of supply that is going to be available in itself will drive down the rate at the auction.
Okay, let's drive things down a little bit into the second part of the conversation, and that's after the break. We have 2 minutes, and we'll be right back.